The Great Depression of 1929 was a severe economic downturn that lasted for over a decade. It began in the United States, but quickly spread to other countries around the world, causing widespread poverty and unemployment. The causes of the Great Depression are complex and multifaceted, but they can be broadly grouped into three main categories: economic, political, and social. Economic causes. One of the main economic causes of the Great Depression was the stock market crash of 1929. The stock market had been on a steady upward trend for several years, with many investors buying stocks on margin using borrowed money in the hopes of making a quick profit. However, in October 1929, the market began to decline, and by the end of the month, it had lost over 25% of its value. This led to panic among investors, who began selling their stocks in an effort to recoup their losses. This selling caused the market to crash even further, leading to widespread financial ruin. Another major economic cause of the Great Depression was the collapse of the banking system. Many banks had invested heavily in the stock market and had also made risky loans, and when the market crashed, they were left with large losses. As a result, many banks failed, and depositors lost their savings. This led to a lack of confidence in the banking system, which further exacerbated the economic downturn. Political causes. The political causes of the Great Depression can be traced back to the policies of the U.S. government in the years leading up to the crash. In the 1920s, the government had pursued a policy of laissez-faire, or hands-off economics, which emphasized minimal government intervention in the economy. This meant that there were few regulations in place to protect investors from stock market speculation and risky lending practices. Additionally, the U.S.